Welcome to the B.F. Anderson Technical Report for July 22nd. Last week, co-chairman of the Federal Reserve, Richard Clarida, now you've got Jerome Powell, who is chairman. Clarida is his vice chair, and from everything I can tell, he's a pretty sharp cookie. Anyway, he was in an interview last week where he discussed the PCE price index, which is Personal Consumption Expenditures Index, year over year. He made it very clear that this was an indicator that they were paying a lot of attention. You hear that the Federal Reserve is data-driven. Well, I think this is really some of the primary data. So as we look at the unemployment index, which we'll look at later, you're going to see the unemployment rate. You're going to see where it really is a very difficult argument for the Federal Reserve to cut interest rates at the end of this month. However, Clarida made it very clear that the Federal Reserve wants to get out in front of the economy and keep things really rolling here, this expansion rolling. And so he's watching the PCE index. So if we look at it, you can see on the graph that we're currently at 1.6%. And he made it clear that the Fed wants to see this get up to 2%. Now what we're looking at is an index of consumption excluding food and energy. So we're looking at consumption of consumer discretionary items, mainly retail. So he's saying that they would like to get this up to 2%. And if you look at the graph going back to 2009, 2% is not outrageous. In fact, it looks like to me that, the highest it's gotten since 2009 was about 2.25%. So if the Fed cuts rates, they're trying to stimulate. I don't think they're worried about inflation. In fact, they want to see inflation pick up. They want to see this expansion continue. So keep an eye on the PCE index. I kind of think it's a way for you to monitor the same data that the Federal Reserve is looking at. So let's get into the charts here. NASDAQ last week, or on Friday, we kind of had a little bit of a pullback. However, we continue to see strength in the moving averages, and the trend continues to be up. Now for the weekly, again, the 35-week has definitely turned up. Volume last week was a little bit on the low side, continues to look positive. The advanced decline line kind of rolling over a little bit here. We got into a very strong uptrend. Now we're kind of flattening out. Really wouldn't be surprised if the market isn't due for some type of pullback or correction. We have had a good run here, and basically the biggest concern I have right now, short term only, is the sentiment readings, which we'll see here in a minute. Now the high-low index, we see a little bit of a pullback, however healthy. New lows, we got a little bit on the high side Friday. We had 54 new lows on Friday. We are kind of starting to drift back above that 40, which is just not a good sign. The long-term indicator, the 10-20, you can see here that we continue to see positive trends here on a long-term basis. You can also see that the index has broken out to a new high. Now this is my concern. This is the put-call ratio. This is a measurement of optimism and pessimism. And it just appears over time from using this that as we get down into these levels here, which indicates greed, now this is extreme greed, and we haven't seen that yet. We did get kind of a retracement and a pullback. Also, if you study mutual fund flows, exchange-traded funds, mutual funds, hedge funds, there have been record numbers of dollars going out of funds, not into equity funds, which can be bullish. So on a short-term basis only, I'm a little bit concerned about the market pulling back a little bit. Here we have the 200-week moving average continues in a strong uptrend. Again, we get the pullback, we get the rally to new high, we get a higher low, and then another rally to a new high. This is very positive. Value line geometric continues to struggle. We just can't seem to break out above the 560 area, but we're keeping an eye on it. The global Dow continues to struggle. The main thing that Clarida did talk about was that their concerns for slow economic activity was more to do with Europe and the international markets. It's really, the United States is fine. It's just the rest of the world. And you can see that the global Dow is struggling. Now, here's the unemployment rate. This is what we were talking about earlier. You know, there's a gentleman out of London by the name of Colin Twiggs who says that he believes that this unemployment rate is probably the most important factor when it comes to anticipating recessions. You can really see here that that cross right there really did predict a recession back in 2000. Here we have '08. Now, right now, we are really in good shape. So the point being is that the Federal Reserve has got to know that at a 3.7% unemployment rate, that could be inflationary, but it just doesn't appear to be the case, and therefore they may continue to cut rates and stimulate the economy. All right, now what I did here is I just took a very simple look at the year 1999 just to make a point to you. This is the recession. The 2000 recession, and we're just using technical analysis here. I do not have the price of the S&P on here. All I have are the moving averages. I have the 30-week, the 40-week, and the 50-week, and you can see that as we went into recession, that the market was discounting recession because all this started to get tangled and very disoriented and went into a very serious downtrend, and bad things happened. So let's take a look at another recession. This was the recession back in '08. Again, you can see the same pattern where you're seeing these moving averages get all mixed up with each other. Looks like spaghetti, going down, got into a bad downtrend, and then bad things happen. But notice here, you notice how this kind of bottoms out and then we start to see improvement. Well, if you look at where we are today, and this is the same moving averages that we just looked at, but this is as of today. So you can see that last year, 2018, towards December, we started to get kind of in a negative-looking pattern. But then, if you look here, back up, at what a bottom looks like, we kind of look more like we're forming a bottom and turning up than forming a top. So this looks nothing like these other patterns here, where we're getting a really serious downtrend, and actually we are getting back into an uptrend. So that's just interesting to note. Now here are the top 5. Again, we're seeing a lot of technology, advanced micro devices, which is semiconductors. Here we have in-phase energy, which is solar power inverters. Continues to look very strong. That's an impressive pattern. Guardant Health, this is a stock that we own. They're involved in blood testing for cancers. This is a very interesting company. Went public about a year ago. Is acting interesting. Here's a company called Anaplan, which is another software. The software stocks continue to be strong. We're seeing a lot of software stocks. Here's Roku, again, streaming. I just bought another Roku and I put it in my kitchen, and it works fantastic. It's really the premier product out there for streaming video over the internet. And so Roku is a pure play. I mentioned last week, you have a lot of companies that are involved in this. Amazon would be, Amazon Fire. Then you also have the Google's involved in streaming. Also, Disney's coming on board with their Disney Plus, which comes in November. You have, Netflix, you have HBO. All these companies are going into streaming, and then Roku is right in the middle of it. So if you have any questions, give me a call. Things look positive. Let's see how this week goes. Thank you.